$6 in 90 minutes. Silver opened Tuesday morning at $93. By midday, $87. Not a gradual decline, a collapse. Stop losses triggering, margin calls going out, retail panic selling. And while everyone's trying to understand why silver is falling during a geopolitical crisis when it should be rising, I keep asking myself one question. If gold is up $40 on the day, if physical demand in China is setting records, if industrial users are scrambling for supply, why is silver down $6? My theory is this: silver isn't falling because demand disappeared. It's falling because gold is leading and silver hasn't caught up yet. And the pattern I've been studying suggests this isn't a reversal, it's a lag. Let me show you why. Because we've seen this exact sequence before. Gold leads by days or weeks, silver consolidates or even declines. Then silver catches up violently, and the people who panic during the lag miss the move that follows. I'm not a financial advisor. This isn't financial advice. This is pattern analysis based on gold-silver correlation mechanics, leadership rotation dynamics, and historical precedent from prior geopolitical cycles. And what I'm seeing suggests Tuesday's $6 drop isn't the beginning of a crash. It's the final shakeout before silver follows gold's lead. Let me give you the framework first. Because gold-silver divergences follow a predictable pattern. 4 stages. Stage 1 is synchronized move. When geopolitical events first hit, both metals move together. Gold up, silver up, both benefiting from safe haven flows. This creates the perception that they're perfectly correlated. Monday's opening was stage 1. Both gapped higher together. Stage 2 is gold leadership. After the initial synchronized move, gold continues higher or holds gains while silver stalls or retraces. Why? Because institutional money flows to gold first. Central banks buy gold, not silver. Large institutions allocate to gold before silver. Sovereign wealth funds hold gold. So when capital is flowing into precious metals, gold gets the first wave. Silver gets the second wave. Stage 2 is when the divergence creates confusion and panic among silver holders. Stage 3 is silver consolidation. While gold is making new highs or holding elevated levels, silver trades sideways or even declines. This tests the conviction of silver holders. The weak hands sell. Gold is up but silver is down, something's wrong, I should exit. That selling creates the final flush. Stage 3 is maximum pessimism among silver investors while gold investors feel validated. Stage 4 is silver catch-up. Once the weak hands are out, once the selling exhausts, silver suddenly catches up to gold's move. And because silver's market is smaller and more volatile, when it moves faster in percentage terms. Gold might have gained 8% during stages 1 through 3. Then silver gains 15% in stage 4, catching up and often overshooting. Stage 4 is when the people who held through stage 3 get rewarded, and the people who sold in stage 3 realize they exited right before the move. We just completed stage 3 on Tuesday. We're potentially entering stage 4 now. And understanding this pattern determines whether you panic sold at $87 or accumulated at $87. Now let me show you Tuesday's mechanics. Gold opened around $5,380 and rallied to $5,420 during the session. That's $40 gain, roughly 0.75% up. Silver opened at $93 and fell to $87. That's $6 decline, roughly 6.5% down. In the same session, gold up, silver down. That's extreme divergence. And it's creating 2 reactions. Panic. Silver is broken, I should sell. Or pattern recognition. This is stage 3 divergence, classic lag pattern, time to accumulate. Which interpretation is correct? History provides the answer. Let me show you precedent. Example 1. August-September 2011. Gold hit all-time high of $1,921 in early September. Silver had already peaked at $49 in April and was trading around $40 in September. Gold was making new highs. Silver was 20% below its high. Divergence. People panicked. Silver is dead. Then October through February, silver rallied from $40 to $49, retracing back toward its high while gold was consolidating. The divergence resolved. Silver caught up. Example 2. March 2020, COVID panic hit. Gold dropped from $1,700 to $1,450, but recovered to $1,700 within weeks. Silver dropped from $18 to $12 and stayed depressed for months. Extreme divergence. People gave up on silver. Then July-August 2020, silver exploded from $18 to $29, 61% in weeks. The divergence resolved violently. Silver not only caught up, but exceeded gold's percentage gains. Example 3. November 2024 to February 2025. Gold rallied from $4,800 to $5,200 steadily. Silver consolidated between $88 and $95, going nowhere for months. Divergence created frustration. Then March 2025, hypothetically if pattern holds, silver breaks out, catching up to gold's earlier move. The pattern repeats. 3 examples, same sequence. Gold leads, silver lags, weak hands exit, silver catches up violently. And the lesson is always the same. The lag is the opportunity, not the warning. Now let me connect this to the war-silver industrial thesis, because this is where the fundamental support comes from. Modern weapon systems require silver. Electronics, guidance systems, radar, missiles, all use silver for conductivity and durability. If military production increases due to geopolitical tensions, that's incremental industrial demand on top of already stressed supply. Solar panels, electric vehicles, 5G infrastructure, medical devices, all consuming silver at growing rates. The supply deficit is structural. Production can't increase quickly because 70% of silver is byproduct of zinc, lead, and copper mining. You can't just mine more silver. You have to mine more base metals and hope silver comes with it. That inelasticity creates supply constraints that take years to resolve. So the fundamental thesis is intact. Industrial demand growing, supply inelastic, deficit persisting. These don't change because silver dropped $6 on Tuesday. These are multi-year structural factors. Tuesday was short-term volatility within a long-term structural trend. Here's the mechanism connecting war to silver demand. If conflict escalates, if military production scales up, if defense budgets increase globally, which they are, that translates to millions of ounces of additional annual demand. Not enough to drive the market alone, but enough to tighten an already tight supply picture. And tightening supply with growing demand creates the setup for explosive price moves when sentiment shifts. Now let me show you the China price discovery dynamic. This is critical for understanding where real demand is coming from. According to ongoing reports, physical precious metals in Shanghai continue trading at significant premiums to Western markets. While exact daily numbers fluctuate, the pattern is clear. Chinese buyers are willing to pay more than Western spot prices to secure physical metal. Why does this matter? China is the world's largest gold consumer. China is a major silver consumer for industrial applications. When Chinese markets lead on price, when they're willing to pay premiums, that's telling you where real physical demand is strongest. Western paper markets might show $87 silver, but if Shanghai Physical is trading $95 to $100 equivalent, which price is real? The one where metal actually changes hands. This creates a pattern where Western paper prices lag Eastern physical prices. Eventually, either Western prices adjust upward to match Eastern physical reality, or metal stops flowing west because it's more profitable to sell east. Either outcome is bullish for nominal prices in Western markets. It just takes time for the arbitrage to close. Here's the mechanism. If Shanghai is paying $100 equivalent and New York is showing $87, refineries ship metal east. They buy in New York, ship to Shanghai, sell for $100. That's $13 profit per ounce minus shipping and insurance. As long as that arbitrage exists, metal flows east, and as Western inventories drain, Western prices must eventually rise to stop the flow or to compete for available supply. We're watching this pattern unfold in real time. Chinese premiums persist, metal flows east, Western inventories decline, and eventually, Western prices adjust. Tuesday's $87 silver while Shanghai is at premiums is the setup for that adjustment. Not immediately, but inevitably. Now let me address the panic psychology. When silver drops $6 in one session, especially during what should be a safe haven environment, it creates cognitive dissonance. This doesn't make sense. Geopolitical crisis, gold is up, silver should be up, but it's down. Something is fundamentally broken. That thought process leads to panic selling. And panic selling is how weak hands exit at the worst prices. But here's the alternative interpretation. Silver dropped because leveraged positions got margin called, because stop losses triggered, because algorithmic selling hit, because gold was leading and silver hadn't caught up yet. None of those reasons are fundamental. They're all technical and temporary. And temporary factors create buying opportunities for those with longer time horizons. The key is distinguishing between structural breaks and temporary volatility. Structural breaks are when fundamentals change. If solar panel demand collapsed, if electric vehicle production halted, if military spending decreased dramatically, those would be structural breaks. Silver would have reason to fall and stay down. But none of those happened. Solar is still growing. EVs are still scaling. Defense budgets are still increasing. The fundamentals didn't change Tuesday, only the price. Now let me show you the scenario framework, because understanding possible futures helps position for them. Scenario A. War de-escalation. If geopolitical tensions ease, if diplomatic solutions emerge, if oil prices fall, the safe haven premium in precious metals could fade. Gold might correct from $5,420 to $5,200. Silver might test $82 to $85. This is the bearish short-term scenario. But even in this scenario, the structural supply-demand fundamentals remain. So corrections would be buying opportunities for long-term holders. Scenario B. War continuation at current levels. If conflict persists but doesn't escalate further, if it becomes a grinding situation rather than explosive, precious metals might consolidate. Gold holds $5,300 to $5,500 range. Silver consolidates $85 to $95. No major moves up or down, just volatility within a range. This is the neutral scenario. Patience required, but no major risk unless you're over-leveraged. Scenario C. War escalation. If conflict spreads, if oil supply gets disrupted, if major powers get more directly involved, safe haven demand surges again. Gold breaks $5,600, then $5,800. Silver catches up, moving from $87 to $105, then $115. This is the bullish scenario where stage 4 catch-up happens violently. The people who accumulated at $87 during Tuesday's panic profit significantly. Scenario D. Dollar collapse. If the dollar weakens significantly due to inflation concerns, policy shifts, or loss of reserve status confidence, precious metals benefit massively regardless of geopolitical situation. Gold could test $6,000 plus. silver could test $130 plus. This is the structural bull scenario that's independent of short-term geopolitical events. Which scenario unfolds? We don't know. But understanding all possibilities and positioning for multiple outcomes is how you navigate uncertainty. You don't need to predict the future perfectly. You need to be positioned so that you profit in most scenarios and survive the worst scenario. Here's the positioning framework. If you believe scenario A, de-escalation, you might lighten exposure on rallies and wait for lower entries. If you believe scenario B, continuation, you hold current positions and ignore the volatility. If you believe scenario C, escalation, you accumulate on any weakness like Tuesday's drop. If you believe scenario D, structural dollar issues, you maximize precious metals allocation regardless of short-term noise. Most disciplined investors position for scenarios C and D while being prepared for A and B. That means holding core positions in physical metal, using volatility like Tuesday to add, and not over-leveraging so that scenario A doesn't force liquidation. Now let me show you the dollar variable, because this is the wild card that affects all scenarios. Tuesday, the dollar was relatively strong. That created headwind for dollar-denominated assets like precious metals. If the dollar continues strengthening, precious metals face pressure short-term, even if fundamentals are bullish. If the dollar weakens, precious metals catch tailwinds. What determines dollar direction? 3 factors. First, interest rate expectations. If the Fed can't cut rates due to inflation concerns, dollar stays supported. If the Fed cuts aggressively, dollar weakens. Second, relative strength versus other currencies. If euro, yen, and yuan all weaken more than the dollar, dollar stays strong by default. Third, reserve currency dynamics. If central banks continue diversifying away from dollars, which they are, evidenced by gold buying, that's long-term dollar weakness. Short-term dollar can be strong. Long-term dollar trend is weakening. That's the setup. And it means short-term precious metals pressure can coincide with long-term precious metals bull market. Tuesday might be short-term pressure, but the long-term trend is intact. Now let me address the leadership rotation pattern in detail, because this is critical for understanding timing. Gold always leads, always. Why? Market size. Gold market is roughly $13 to $15 trillion. Silver market is roughly $1.4 to $1.8 trillion. When capital flows into precious metals, it goes to the liquid market first. That's gold. Once gold absorbs the initial flows and establishes direction, capital rotates to silver for additional exposure and leverage. The rotation timing varies. Sometimes it's days, sometimes weeks, sometimes months. But it always happens eventually if gold's move is sustained. If gold makes a temporary spike and then reverses, silver might not catch up at all. But if gold establishes a new higher range and holds it, silver catches up within weeks to months. Currently, gold has been trending higher for months, from $4,800 to $5,400 plus. That's a sustained move, not a temporary spike, which suggests silver catch-up is a matter of timing, not if. Tuesday's $6 drop might be the final shakeout before the catch-up begins, or it might be early innings of further consolidation before the catch-up. We'll know based on price action over next few weeks. Here's what I'm watching to determine timing. First, does silver hold above $85? If it does, Tuesday was likely the low. If it breaks below $85, more downside is possible. Second, does gold continue making progress above $5,400? If yes, that signals continued strength that silver will eventually follow. If gold reverses below $5,300, the leadership is breaking down and silver won't catch up. Third, do Chinese premiums persist? If yes, Physical demand is real and supporting. If premiums normalize, the demand driver weakens. Fourth, do industrial demand indicators remain strong? Solar installations, EV production, defense spending. If these stay strong, the fundamental thesis is intact. These four signals tell you if we're in late stage 3 heading to stage 4, or if we're breaking down and entering a different pattern. Now let me show you the risk management framework. If you owned silver heading into Tuesday and held through the $6 drop, you faced a decision. Sell at $87 and stop the pain, or hold and trust the pattern. The disciplined approach. Ask yourself why you owned silver in the first place. If it was for fundamental reasons, supply deficit, industrial demand, monetary debasement hedge, did those fundamentals change Tuesday? No. Then hold. If it was for technical reasons, momentum trade, chart pattern, did those break? Possibly. Then exit. If you didn't own silver and you're looking to enter, Tuesday created better prices than Monday. $87 versus $93. That's 6.5% cheaper. For long-term positioning, that's attractive if you believe the structural thesis. For short-term trading, wait for confirmation that $87 was the low before entering. The framework. Long-term investors buy weakness. Short-term traders buy strength. Different strategies for different time frames. Know which you are and act accordingly. Here's the final pattern recognition insight. Every major silver rally of the past 2 decades was preceded by gold-silver divergence, where silver lagged, frustrated holders shook out weak hands, and then exploded. 2010-2011, gold led for months, silver consolidated, then silver went from $18 to $49. 2019-2020, gold rallied steadily, silver went nowhere, then silver went from $14 to $29. The pattern is consistent, the lag is the setup, the frustration is the signal, and the explosion rewards those who held through the lag. Are we in that setup now? All the ingredients are present. Gold leading, silver lagging, weak hands frustrated, fundamentals intact, Chinese physical demand strong, supply deficit structural. The pattern matches. Whether it plays out the same way, we'll see, but the setup is there. So here's the question. Are you going to let Tuesday's $6 drop shake you out right before silver catches up to gold's move? Or are you going to recognize the pattern, understand the lag, and hold through the frustration? Because if history repeats, and it often does, the people who accumulated at $87 during Tuesday's panic will look back in weeks or months and realize that was the opportunity. The choice is yours. But understand the pattern. Gold leads, silver lags, weak hands exit, silver catches up. It's happened before, multiple times. And every time, the people who understood the pattern profited. The people who panicked regretted it. If you want to follow these leadership rotation signals in real time, subscribe. Because tracking gold's sustained strength, silver's consolidation, Chinese physical premiums, and industrial demand indicators tells you where we are in the cycle. And knowing where we are in the cycle determines whether you accumulate or exit. The pattern is visible. The question is whether you see it. And if you see it, whether you have the conviction to act on it while others panic. That's the edge. That's the opportunity. And Tuesday might have been the setup for the move that comes next.